Welcome back to Higher Exchanges. I'm your host, Jesse Redmond, Head of Investor Relations and Business Development at Leaf Brands. I'm joined this week and every week by Morgan Paxia. He is the co-founder of Poseidon. Morgan, what's happening, man?
Oh, it's earnings season, so swimming in the queues.
Yeah, are you
But
feeling
doing
depressed?
well.
Are you hanging in there?
I mean, my saying, dead inside, so it's all good.
Yeah, not surprising to see some tougher quarters, but looks like estimates are getting cut. And we were chatting a little bit before the show, and it doesn't feel like there's any reason for things to imminently change over the next quarter or two. Probably need Pennsylvania or some farm bill relief to start moving these MSO names.
Yep.
But
We got to get out of this cycle for sure.
Well, Morgan, we are not here alone today. We're lucky to have Zach George with us. Zach is the CEO of SNDL. Zach, how are you today?
Doing really well. Thanks for having me, gentlemen.
Yeah, we're excited to have you. Morgan and I have been talking a little bit about SNDL, and you guys have a lot of exciting stuff going on. So we have a lot of ground to cover today. But for folks that don't know you from before, Zach, why don't you tell us a little bit about your background and what you got you into this crazy world of cannabis?
Absolutely. So I am importantly, managing a Canadian business, a dual citizen, which is relevant from a number of factors when you think about the way that this industry is expanding from a regulatory standpoint. But professionally, earned a law degree and passed the New York bar before taking a hard left into banking. I was originally trained as a credit analyst before spending about 20 years in the alternative investment space. Ran a hedge fund with partners over more than a decade and was involved in quite a bit of both passive and activist investing. So became a student of governance as well as was able to gain experience participating in takeovers and turnarounds. Was approached in late 2019 to help out at the board level with SNDL and saw an emerging industry that was going to be very, very large and was somewhat drawn to, I would say, two factors. One, Canada's federally legal framework, but also there were some enormous challenges at SNDL, and I tend to get drawn into projects that involve that are fraught with stress and conflict, and those factors were definitely there with SNDL. So that started my journey. Became the CEO in early 2020, and so earlier this year would have marked 5 years in the seat.
And can you unpack a little bit more specifically about what drew you into cannabis, what your expectations were, and then also talk a bit about what's changed? Like, has it been, I think one theme we talk about in higher exchanges is this has been harder than we expected. This is taking longer than we expected. I'm thinking often more from an MSO type lens because I live here, used to cover a lot of those stocks, currently work for a US operator. But maybe talk a little bit about what got you into this space and how your expectations have evolved over time.
So I was invited to play a fiduciary role with SNDL, as I mentioned, first at the board level. And so they had some specific financial challenges, some governance matters that needed to be attended to. And there were some important negotiations that had to take place with stakeholders, including their senior lenders. And so those were priorities that I believe I'm ideally suited to deal with, given my background and experience. And those types of problematic, big, hairy situations are always very, very interesting to me from a personal and professional standpoint. They can be extremely rewarding, and there's usually an opportunity to create a lot of value for stakeholders. So that's really what drew me in. And in terms of initial assumptions, I would say I did not come to the table with a deep background in cultivation. Was a casual consumer over the years. I lost my father to cancer related illness just over 7 years ago, and these products helped him gain some relief when he was going through the worst of his chemotherapy. So I had interaction with the products, with the plant for sure, but didn't have specific experience in big scale ag. Did have a lot of experience with building performance cultures and making sure that the right factors were in place to align the interests of the management team with those of shareholders. And so what had an interesting sort of starter kit of a business with a cultivation heavy focus. And we've worked aggressively to evolve that over time with retail and other opportunities beyond Canada.
And are there any experiences, any periods, experiences, deals from the hedge fund days or situations you were involved in that have helped you in what you've been trying to accomplish at SNDL?
Yeah, absolutely. And I would just say that I've truly been a student of governance, understand through participation and service on over a dozen public company boards and in a number of officer roles directly serving and managing companies, the types of conflicts that can exist, the how easy it is for companies to slip into bad behaviors, which drive poor outcomes. And so those experiences and being in some really, really difficult, hostile rooms over time and trying to sort through some very thorny challenges, I think put me in a great position to deal with the challenges that were apparent with SNDL back in 2020.
And are there any particular things when you came into SNDL you looked at and you said, either I like this and I really want to keep that, or hey man, we got to stop doing this part? Like, are there any big lessons learned, either things that are positive or things you said, hey, we need to change this?
It's a great question. So we didn't have a choice in certain respects. From the minute that I stepped in, we were under massive pressure from our senior lenders. In 2020, as I stepped in, my role was really more of a CRO role in the classic sense than CEO, because our senior lenders, which were ATB and BMO at the time, were actually trying to push the business into CCAA. So we were in special loans. The way I described the business at that time, if you ran a screen for public companies and the criteria was show me an equity that 6 months past the IPO had been cut in half, where the business would be in breach of bank covenants and struggling to meet payroll, it'd be a really short list of companies, but we would have been on that list, right? So once you're in special loans in the Canadian experience, less than 4% of companies ever make it out. We were able to defy those odds and did so with some decisiveness and very quick dancing, which meant that we had to dispose of the largest glass house in the UK, which is based in Spalding, acknowledge that we had built the largest pure indoor cultivation and processing facility under prior leadership in Canada, but that given its position in Alberta, it wasn't going to be competitive with a number of other facilities in Canada, and so and that was really driven by the volatility in the power markets. And so faced a number of very difficult decisions and required that we pivot. So many of the sort of foundational principles that the company was originally built on had to had to be changed materially, and that's very, very difficult. Change management is always difficult within a company, but when the mantras and the strategy that's been touted to staff for a period of years has to turn on a dime, that can be very, very difficult.
Yep. And you touched on something earlier I want to go back to, then I'll throw it over to you, Morgan, to talk a little bit about Canada. But I love this topic of culture, Zach. I think culture is an underappreciated thing about businesses. And I'm particularly interested because we face different challenges in this virtual world. Like we were talking earlier, you're in Connecticut, I'm in California, Morgan's in California, our CEOs in San Diego, our CFO is in Toronto, our main extraction facility is in Mendocino County. So we have people all across the state of California and soon to be people in New York as we open up there too. And I often think about how do we get culture to permeate across this group of people that not only are different locations now, but in many cases are virtual and also come from different backgrounds. Like some of the best guys at our company weren't people that have fancy degrees and weren't people that worked at Wall Street. They've been in cannabis their whole lives, and that's equally as valuable and fantastic as well. But that's a different cultural field than some of the ex-Wall Street people have. So I'm curious what culture means to you, Zach, and how do you get culture to permeate across an organization with so many different types of people in different locations?
It's a great question, and it's sort of a never-ending journey that you end up on. But you're right to call out the the varied and very different backgrounds that have been drawn into the industry and are actually critical at every level for some of the skills and tasks that we all need to perform. I would say that when I think about this topic, and I get asked about it quite a bit, when you think about priorities as a business, I look at it in terms of governance, strategy, and execution. And maybe goes without saying, but culture has nothing to do with Fridays off or beer taps in the office or ping pong tables. There have been many firms that have been fashioned in sort of the mold of their founders, and somehow that's supposed to be the driver for culture. When I look across the challenges that our company had in the early days, which we've moved well beyond at this point, or the challenges that the industry is going through, I think it's really simple. If you're not building a performance-driven culture every day, one of your competitors will be, and you are going to suffer as a result. And so what does that really mean? It comes down to all the business basics. How deep into the organization have you pushed an awareness of the operating performance? Do they truly understand the drivers and the impact that decisions can make? And are you in a position to communicate effectively, to really drive excellence through execution? And keep setting the bar higher every day, right? Because it's not just about what you or I do. This is every level of management, every member of the executive leadership team, and several layers down in terms of management, right? It's got to be a culture where accountability is ever present, and there's a discipline to continue to work on these skill sets, and have, in some cases, very difficult conversations with team members.
Real quick, before we jump into Canada, I think it's super interesting that you've been on, you said a dozen or so public company boards?
Correct.
That's really interesting. Are you currently active on these boards, or is that all from previous
I'm not.
times?
I stepped off my last independent board just over 2 years ago.
Okay.
And I have a sort of maybe a non-linear, non-traditional background. I was put in a position where when I was in my 20s, I ran my first proxy contest and took control of a New York Stock Exchange listed company through driving a majority change to their board. And so my hedge fund experience worked with partners where we engaged in 36 different activist transactions, some which were friendly, some which were less friendly. But we were able to drive meaningful change in over 90% of those cases, and created value in most. So that's really the lens that I come from in terms of driving corporate action through making sure that you have an engaged board that's focused on the right thing, that's holding management accountable for their objectives.
Yeah, governance is a big thing for us too. Emily and I constantly are professing it. It's interesting to hear about the work that you've been doing there up to this point, and what you're doing continuing every day. But were there any sectors or areas of focus that you were doing it with, or how did you come across all these?
I would say earlier in my career was really focused on what I would just consider sort of old world hard asset businesses. So collection of industrials, real estate, energy. Was never engrossed in high growth technology or other sort of higher risk volatile sectors, but have always been a student of different industries, and I'm always clamoring to learn more about successful business case studies.
Yeah. There's endless amounts of learnings from various areas that are applicable here, and it sounds like some of those areas were certainly helpful for the work that you've been undertaking there. So let's start off the top. We got a bunch of areas of the world to cover here with SNDL. So starting with Canada, where it all kind of began for SNDL. They as a country been ahead of us as far as going through this pricing compression cycle, capacity, overbuild and correcting, and seems like from what I'm reading and seeing a bit, and what we're hearing from folks as we're talking to people, especially here on higher exchanges, it seems like that cycle is starting to improve. But curious where you see things as far as overcapacity pricing. What's kind of your view of the Canadian landscape at this point?
Yeah. So in 2023 and early 24, I was publicly talking about the Canadian industry troughing effectively. And I would say exactly in line with your comment, Morgan, that we are seeing the industry come out of that trough. And there was a number of drivers, for that. And so I think it's a very interesting and dynamic environment. When you think about investor sentiment and even the perception of successful and ingrained insiders in the industry, I think in the last in the earlier years of my tenure, which started in 2020, there was really strong negative sentiment around Canada, and I think people are starting to realize that between some of the oversupply issues healing themselves, operators figuring out at the margin how to generate economic value, free cash flow, and even net income in some select cases, combined with the ability to participate in a major way in international trade, is all of a sudden looking reasonably attractive. And with some of the continued, it's not that Canadian operators don't face challenges, but a different set of challenges, I would say, than what you see in a lot of U.S. states. And so there's a whole world, north of the U.S. border that functions very, very differently. So you have that federal and national, market for one. You don't have to deal with restrictions on interstate commerce. You don't have a farm bill, so you don't have vagaries around intoxicating hemp and the debates that happen around it. And the reality is that global markets are growing at a rapid clip. The way that I would explain it, factually, there are more people consuming THC in various forms around the planet every single day. It's just that underneath that surface, with that very strong demand signal, there's quite a bit of chaos and dysfunction, as you guys are well aware. And so, battling through that to create a business model that will deliver long-term sustainable value to shareholders is our goal. And we feel a lot of gratitude and great fortune to have a base in Canada from which to expand from as we build confidence and demonstrate success.
Do you think you mentioned it was basically like three big factors, right, for Canada that helped it get out of the cycle? One is access, right? Retail really expanded over that time.
Yeah.
Two was the ability to start exporting, so that really helped from the supply demand imbalances. And three, I guess, would be learning, like groups actually learning how to run their businesses better, become more focused on cost discipline. And is that a fair summation of kind of the landscape?
And maybe one important footnote would also be we had what happens in commodity markets, right? When prices dip below the marginal cost of production, well, typically that production is shut in, and that's exactly what happened. We saw large scale hybrid glasshouse facilities converted to back to vegetable production, and so it's fun to talk about shortages. It's fun to talk about pricing power, where we don't even know what that word means in this industry anymore, because it seems like the cycle moves one way. But the first order question is, how high can we push prices? The second order question would be, how are scale operators going to react to higher prices, right? And as we speak, there are plans either activated or on the table to open up additional capacity. So seeing how competent operators react to the cycle on the other side of this is also a really important question.
Do you think having the expanded retail and learning more about consumer behavior allows for better product differentiation, having a value product, but then also having a more premium-based product? Is that also helping to drive some of the pricing discussions?
So the premium market from the Canadian landscape is sort of high single digits max, and you've seen a lot of compression on pricing regardless. The way that I would contextualize this, if you think about a market like Florida, which has enjoyed very robust pricing and margins for quite a long time, you see, if you look at the top 5 operators, and because I just don't want to talk about names, but one of those top 5 operators is using $10 eighths, for example, as to draw foot traffic as a door crashing item. Others are resisting that. We've been living in that world on pricing, currency adjusted, for a very long time. So what looks like a scary sort of all-time low in some US markets, that's been our day-to-day for years in Canada. And so the type of discipline and leanness that's required to be successful in that type of environment has, I think, given a lot of operators, including our teams, experience a lot of scars, but also a lot of confidence in what models work, and also what really drives consumer behavior at the end of the day. And yes, owning retail and seeing tens of millions of individual transactions is a great way to gain those insights.
Do you, Jesse? I didn't know if you want to jump in with something. It looks like you had a question. No, you're good.
It was a head fake. I just scooted up closer to my mic.
Okay. Yeah, it's very interesting. But just back to your point about the marginal cost of production, is kind of $10 eighth, is that kind of a line in the sand as a rough number? I know there's different cost structures in different geographies and all that stuff and regulatory regimes, but is that a reasonable number where you saw?
So that I'm speaking in reference to the U.S. operators, that would be a USD, quote. And so we've seen lower prices, but whether you go to the OCS as a reference with their online store, or look across Canadian retail at products, that would today represent the low end of where you'll see flower being priced. Another way to think about it, we had a really successful 28-gram bag, and at the lows that was trading at about $55-56 Canadian. So that's a $40 ounce, right? And because of the excise tax regime, you would see $28 of that $56 purchase go to the government in the form of excise tax. So no industry faces the type of tax structures that this one does, as you guys are well aware. But those same value ounces that were trading in the mid-50s are now in the 80s. So we are seeing significant shift. I think the other question is what impact will, and when we talk about supply-demand imbalance or shortage, the way I would characterize it is there's still flower out there, but there are pockets, right, in terms of specific grades and types of biomass and flower that are in short supply. You've got operators and cultivators who typically for the domestic rec market in Canada would be shipping finished goods to a provincial board warehouse where retailers would pull from. And they are actually shorting the province because they can engage in export on a excise-free basis and earn better economics. And that's creating volatility in terms of availability in certain cases, and also opportunity for those who do want to plug those gaps and deliver for the domestic consumer. So there's quite a lot in flux right now.
And Zach, what are people doing to hit that price point? Because I think here in California, I see the $10 out the door eighth, and that's from Glass House has one called Allswell. And the way that they're making margin on that, I guess, is three things. One is that it's sun grown because they have the Glass House facility. Two is in the post harvest processing, machine trimmed rather than hand trimmed, which saves a little bit of money. And I believe it's only offered through their own stores, and so that helps too with some margin there. So I see how it can work in a certain context in California, but how are people hitting that price point and surviving in Canada?
So look, a lot of the same dynamics, Jesse. What is critical to Glass House's success, right? Are we going to see a robust national industry? And if so, what's going to happen to these smaller indoor facilities that are smattered around the country, right? We're going to likely see the activity on the cultivation side get very aligned with typical agricultural production. And so there are some areas of Canada, including southern British Columbia, including Ontario and Quebec, that are very rich in terms of their agricultural history and contribution to North American food supply. They also happen to benefit from being tied into hydroelectric power sources, which are very reliable and extremely cheap. And that's where you'll see, some of the most competent operators of Glass House environments compete quite well with the likes of a Glass House when it comes down to cash cost of cultivation on a per gram basis. And also what's driving this opportunity internationally, where you have even indoor product, when managed appropriately, will come in with fully burdened cash costs below $1 Canadian. which is really competitive by any measure, especially when you put that in the context of a country that actually has a rule of law, respects property rights, etc., where you can do business with relative certainty.
Just one last question I have on Canada, and then we'll pass it back to you, Jesse, for our next region of the world to discuss. So what I really am getting interested about Canada is what you're proving is that good companies, I know there's still plenty of challenges out there, but good companies they're finding a way to move forward. They're finding a way to profitability. They're just figuring it out, and through learning and discipline and experience, and doing all of this without any legislative progress yet. Or before I get to my question is, the big challenge we have here in the U.S. is all these investors are like wanting a catalyst, or I call investors, wanting a catalyst before they think it's okay to invest, instead of like looking at the few companies that are emerging through this and actually have a balance sheet, have management discipline to, go through this cycle that we are still going through, that you guys are probably, I guess, a year and a half ahead of us on in this discussion, but they're still waiting for a catalyst. But is there any legislative changes coming could further bolster some of the progress you're seeing?
So I think it's like a sort of a split answer. Do we expect regulatory reform that will be positive for the industry in Canada? Yes. Do I think that that's going to change investor sentiment or be a catalyst that's sufficient to draw in institutional capital? Probably not. We're talking about, I think, a very reasonable and sort of trying to set the bar pretty low on expectations. We've had changes to regulations to make our workers inside of retail safer. We've had recently some packaging changes which allow for product to be visible through a window. Hardly what I would call real innovation. We're expecting to see a change to milligram limits per unit in Canada. Right now, in the edibles category, there's a 10 milligram limit, which creates a lot of inefficiency from a packaging standpoint relative to the sort of the down the fairway offering in the US, which would typically be 100 milligrams with, say, 25 milligram gummies and some variations around that. So we're expecting that to change. There's similar to the US, but in a different form. There is rampant and widespread deferral of excise taxes. And so really kind of skews the playing field for operators that are paying all of their taxes. We would be one of those companies. And so we're not expecting meaningful excise reform in the near term, but we're looking for opportunities where we can be quite aggressive in terms of conversations with government and the regulators to find mutual benefit that actually doesn't take any capital out of government coffers. So, for example, excise stamps, right, today are a big issue. If you build a pallet of product and it's destined for BC, you put a BC-oriented excise stamp, on it, and then if you need to reallocate based on a change in demand to another market, you either have to destroy or relabel that entire pallet of product one by one. So having a national excise stamp, and even a virtual one at that, would provide supply chain flexibility that would be worth, to a company like ours, that would be worth millions of dollars a year. And so that's something where the industry can benefit from a very rational change that, again, doesn't take a single dollar away from government coffers. So I think we'll see reform in time. The stats are crazy. The cannabis industry in Canada is just over $5 billion, kind of OTC. The liquor or alc bev market is over 25 billion, so it's 5x. And on a gross dollar basis, the cannabis industry is contributing more excise tax dollars than liquor, right? Which means they're paying it at over basically 5 times the rate in certain cases. So will this change over time? Probably. Will it change soon enough to change the competitive dynamic and save a bunch of companies that otherwise wouldn't be? I wouldn't bet on it.
So you mentioned, Zach, that you don't think excise tax reform is a catalyst that's going to draw meaningful institutional investor interest. What do you think would spark more interest in investing in Canadian cannabis companies or SNDL specifically?
So sorry, what I was trying to say is that I don't believe excise reform will happen in the near term.
Okay.
If it were to occur, it may actually, as you suggest, be a catalyst for institutional interest. But I think more importantly, you need to see strong businesses with a long-term track record of earning stability, best-in-class governance, best-in-class reporting standards, and the type of economic value add that draws in institutions. And so I don't think it's just about the stigma, but I believe that even institutions that are looking, or even assigning, say, like a summer analyst to build a file, say, on this sector, this opportunity set for their review, they're watching behavior very closely. And I would say that the behavior they would have seen in the early days of this industry was pretty horrific at the margin, right? So not the type of results or behaviors that would inspire confidence and draw institutions. I think that's changing really rapidly, but hard to say when we'll fully crack that code.
So let's talk about something that might drive a little bit of growth, because I think one thing we're all looking for in the cannabis industry is growth right now, and that's Germany. We had Hirsch Jane from Anenda Strategy on last episode to talk about Germany. He joined us live from the big conference in Berlin, and I love that conversation. Pretty excited, Zach, about how that market is evolving and opportunities over there for Canadian companies to participate. Can you talk a little bit about your perspective on Germany and specifically how SNDL is playing that market?
Yeah, so we're currently actively involved in export to partners in a number of countries. I would say that it's a small but growing and important part of our business. We right now are predominantly shipping wholesale flower in different forms. Germany specifically, is it a very exciting market? Yes. If you look at the sort of some of the equivalency numbers, if the math is pretty easy, because you've got over 80 million residents of Germany. You've got just over 40 million in Canada, so it's legitimately twice the size. And if you look at the state of play in Canada right now, and you assume that, say, 40% of the cannabis market is dried flower, that really looks like something close to 2 billion euros in terms of market size. So when you think about this robust path to growth, and you assume that this market in Germany is going to be, even on a conservative basis, restrained because of the lack of 2.0 products that are available today, and just focus on flower, you are looking at multiples of growth even to get to a Canadian equivalent market size on flower. So we saw over 70 million tons of biomass get exported from Canada in 24. To kick off the year, we were seeing over 15 million tons 15 tons a month. And so we're seeing that market double this year versus last. It doubled last year versus the prior. And so there's quite a bit of growth. I would say from our side, we're students of the market right now. We've looked at a number of potential opportunities to invest and haven't connected on anything yet. We have real priorities and work cut out for us in North America, both with our growing retail business in Canada, and then the soon to be completed reorganizations of some US businesses. So very interested in what's happening in Europe, but I would say over the long term, is it a strategic imperative or a sustainable model to be one of a dozen or more parties exporting flower to Germany? I would suggest that's not going to be a business with a strong moat around it. Really hard to tell, 5-10 years from now, whether Portugal will be ramping aggressively, what other countries will come online, will there be an opportunity to export from the US in the future? So we're really looking at, I would say, opportunities that would be adjacent but an analog for what we're doing in Canada. So in Canada, we focused on owning critical parts of the supply chain that enable us to really own the relationship with the consumer, right? And so looking for similar opportunities, again, being one of many exporters of flower, you are providing what is a relatively a commodity-like service, right? Versus owning critical infrastructure where you can own the relationship with physicians, pharmacies, patients. And so we're really watching some of the strong and high-quality distributors emerge. It's a pretty wild landscape right now, and a bit of an arms race, but we are seeing some companies that we think will be there for the long term, and supporting them and trying to learn more to figure out how we can play a role in that market.
And is that export business largely priced on just a THC per dollar basis? And is it pretty fussy or pretty competitive in terms of margins for that reason?
It's been all over the place. And most of the, I'd say, smaller cultivators that are active in Canada would bring the conversation quickly to quality. But even the German distributors have gotten smart very, very quickly, and they're looking at value segments. They're looking at, milled flower. They're evolving very, very quickly. And in the earliest days, you saw what we've seen in the U.S. and Canada in newer markets where there's like this obsession with strains, right? And very quickly, potency and price are coming into play, and reliable supply. A lot of these purchase orders will come into Canada, and despite best efforts, some of these players can't actually deliver on order volumes, and so they'll either partially fill, not be able to fill. And so what that means is today, some of these distributors are having to go out to several dozen different operators to try to have a workable supply chain, knowing that not all of those relationships will be successful. So it's creating a number of distortions in the short term that are interesting to watch. But I would say that, look, are we seeing flower trade internationally between $2 and $4 Canadian? Yes. Do I expect price compression over time? Absolutely. Is Canadian flower competitive with other regions? It absolutely is. And I think it'll continue to be, although certainly other markets will open up, and the U.S. will be a wild card, in terms of future role in international commerce. But what's also interesting is just not to flip flop on currencies, but when we visit Europe and or Germany, and we get to go back a house of pharmacy and see scripts getting filled and product getting packaged, when you look at the cost of these products and flower as it faces patients, you're looking at somewhere between €4 and €8 typically is sort of the strike zone. So there's a lot of margin here outside of what's being earned by Canadian producers, and that's being shared amongst a number of middlemen and participants in that market. And I would argue that those margins will also get challenged and compressed over time. It's just a matter of how and when.
Whenever you mention the word milled flower, Zach, I just have to cringe a little bit. It just makes me, because I just don't know why. Did people not have a grinder? Did they want the flower to be drier and lose terpenes? Or am I missing something there, Zach? Like, what is the appeal of milled flower?
You and me both. So I would, I guess, I shout out a Canadian company that came with that product very early, several years ago, and, did really well. What I can tell you is that I've learned that there's two real drivers for consumer behavior in the space, and it's really convenience and price.
Yep.
And so to me, it's on the spectrum of convenience. So there's the ritual of dealing with flower to consume it. There's the ease of buying a pre-roll. This is some intermediary step where, you didn't want the grinder and you want a highly processed milled product because you still want to roll it yourself, but you don't want to go through the agony of breaking up the biomass. So, there is a target consumer that absolutely is enamored of that product. It may not be you, I might not also be the target consumer, but there's a real history of success there.
Yeah, I've had to accept in cannabis things that make me cringe. Don't mean that they're not great products. So yeah, but milled flower, we don't see a lot of that in the U.S., but I hear about it more in Canada. So let's transition.
It seems like that would.
Good point. Sorry.
Well, I was just saying, but that probably for shipping to Germany is probably way more efficient to be milled, right? Because it probably packs very well. You don't have any lost weight, and so it probably makes it much better from that purpose. But appreciate the convenience and price is
Yeah.
certainly the mindset.
I think that's
of the
absolutely true, Morgan. But also, like, this stuff all packs really well in light as well. So it's a very marginal difference, right?
So let's look a little bit at other international markets. I know you're active not just in Germany, but other places. Do you want to talk a little bit about some of these other markets across the globe? I know names that come to mind are like Malta, Israel, UK. Where else is SNDL active, and why do you choose those markets?
It's great. So we're really looking for demand signals. So to just state our course as if we choose what market, maybe I'd be overstating it to say that. We are getting contacted by counterparties who trust the work that we're putting together. They see the amount of product that we're building for consumers in Canada. They understand that we not only have a robust branded business, but we're also manufacturing product on a B2B basis, where we're building certain SKUs for a number of the top 10 LPs in Canada, and also participating in just about every major medical channel in Canada as well. So markets that I think are interesting, Malta, I don't want to go down a rabbit hole on, but really see that as more of a regulatory based opportunity, not a specific market or source of demand that would be of interest. Although its status will play a role for certain players in the future. As you're aware, and this was discussed on a conference call for earnings today by one of our peers, Israel has been going through a situation and taken a number of protectionist measures, which are unprecedented, effectively using anti-dumping policies to try to restrict export or drive massive tariffs to Canadian players. That will get itself worked out over time, which it's really unfortunate, but don't see it as a material issue. I'm pretty excited about the UK, frankly. And when you look at Canada, very similar parliamentary system, rule of law, no language barriers. That market was sort of just trickling in terms of growth for quite a while, and seems like we may be reaching an inflection point where a logjam really breaks. We have branded product in the UK market. We have vape and edible SKUs landing this year in that market as well. So we think there's a lot of opportunity there. One note that I think is worth pointing out is, if you just look at the rate of vape consumption generally in Canada versus the UK, with its really strong history and relationship with tobacco consumption, the rate of consumption is more than 2 times on a per capita basis than Canada. So I think that there's a number of areas, specifically in the inhalable product channels, for our sector, that are going to play extremely well in that marketplace.
Have you looked at Australia at all?
We have been involved through subsidiary companies historically, and we are not very active or aggressive in that market today.
And so how do you think about international expansion and balancing that with the Canadian business? Like, how do you decide how much time, effort, and capital to weight to one side to the other? Like, I think of it kind of like allocating capital from a hedge fund, right? Like, how much do you decide to put in each bucket? And given your strong background in capital allocation, how do you think about those two markets and how to allocate?
Yeah, so we've beaten this mantra to death, privately and publicly. But look, our capital priorities are really clear. And it's not just taking my word for it. The actions, the announcements, the commitments we've made are all in line with this. So we are focused first and foremost in building out and continuing to drive strength through our Canadian business, which is a vertical operation. And so we recently announced the acquisition of a 32-door portfolio owned by a small cap company called 1CM. We expect to close that acquisition in the third quarter. That'll take us well north of 200 doors in terms of our cannabis retail network. We expect that it'll drive material operating income to our model, and effectively we'll be spending about $32 million of our unrestricted cash in that process. We have some relatively well understood restructurings in the U.S. that we're dealing with, including SkyMint and Parallel. And so to both shore up and drive the next leg of growth for those businesses, we are looking at smart ways of deploying capital. And then I would say, again, we're students of these international markets trying to look for the right opportunity. If we don't see the right sort of pitch come across the plate, so to speak, we're going to be very, very disciplined. Right now, that export business is really helpful in terms of reaching our budget targets and our free cash flow objectives. Most of those transactions are accretive from a margin perspective. And so areas where we may see volatility or even fall slightly short of a budget objective, this is very interesting business that we can move on quickly and can bridge some of those gaps. So it's a phenomenal opportunity in small scale today. And we're working on ways to participate in a more material fashion in the future. But that will all happen in the right way if we have the right base. And if we were to neglect the opportunity set in North America, we're almost certain to not have those opportunities internationally. So one will beget the other, and we need to, with a big, robust model that is multi-segment, multi-asset class, multi-disciplined. We have a lot on our plate right now. We just last quarter put up record gross margins north of 27%, and expect those to go materially higher in the future. And so the initiatives that our team are working on are really critical to that. So we believe that we are best to stay focused on our existing and core exposure prior to taking large risk internationally. But that could change very quickly as specific special situations emerge or relationships drive opportunities.
Well, that's great. Why don't I pass the virtual mic back over to you, Morgan? I'm super excited to talk about U.S. opportunities as well.
Yeah, well, Zach, you kind of alluded to it already a bit of some of the exposures you have here in the U.S. and some things that may be in the works as far as getting, with SkyMint and Parallel. But you've also been communicating about potential plans of how you would like to explore more in the U.S. But why don't you give us a rundown of the recent filings and what that might mean for SNDL and becoming more active in the U.S.
Absolutely. So just for maybe some members of the audience that aren't aware, back in 2021 we formed a joint venture called Sunstream that would enable us to, on a compliant basis, deploy capital into U.S. cannabis while maintaining our NASDAQ listing. And in order to do that, we needed to build out a credit portfolio, which also happened to be interesting just because of the elevated cost of capital generally in the space, and realizing a much better attachment point for some of these companies versus taking outright equity exposure. And so deployed capital into a number of credits on both sides of the border. Much of that capital was repatriated and returned with all fees and interest. In a number of cases on both sides of the border again, we ended up either in some form of restructuring, whether that be receivership, foreclosure, or in Canada, CCAA. And so we've actually taken 4 different companies in Canada through those processes. The most recent was Indiva, where we had a $22 million credit bid late last year that was accepted. And as a result, we are now the largest manufacturer of edibles in Canada, manufacturing for Wana, for Grown, as well as a number of other brands that are owned by third parties, as well as our own house brands. So that's an interesting piece of business. In the case of the U.S., there are 2 credits secured by assets of both SkyMint, which is a Michigan-based retailer, and then Parallel, which is a multi-state operator with a vertical model in Florida, Massachusetts. They're one of a small number of license holders in Texas. And that Florida business really, it hasn't grown significantly because it's been in this foreclosure and restructuring process for almost 2 years now, and basically slipped. But even despite that lack of activity, as peers opened new doors and ramped production, effectively it slipped from being a top 4 operator in Florida to a top 5. But we believe that there is a significant consolidation opportunity in Florida, and expect that as we get to the other side of this, we will likely be exploring a lot of those interesting conversations to get to scale and challenge some of the larger operators in the space. And we come to it with a perspective on, what was a very, very deep trough in the Canadian cycle, which is informed and given us really strong views about how to position retail, how pricing works, and how to manage these product categories generally. Morgan, you referenced our public announcements. And so with our earnings release recently, we announced that our board is going through a strategic review, not maybe the typical announcement that you would expect to see when a company is exploring its sale or inviting in bids from other companies, but rather this unique situation that we find ourselves in with regard to our listing status. And so our board needs to make a decision as to whether they want to take one of 2 options. One would be the status quo, where effectively stay on NASDAQ. And in doing so, we would never be able to engage in plant touching activities in the US. And so you'd have sort of an agency and governance sort of break, so to speak, in terms of the capital exposure we have to US enterprises. And the second option would be to migrate off of the NASDAQ and take a posture that's taken by the top 40 US cannabis operators out there for the most part, where they have a combination of an OTC markets listing along with either a CSE or TSX listing. So that review is ongoing. No decision has been made, but the implications for the business long term will be material. And the consolidation of businesses, we just in 2024, it was our first year of free cash flow generation on an unadjusted basis, and we did about $920 million in revenue. These enterprises in the US on a consolidated basis would add another approximate $300 million of revenue. So it's an important decision for the board to review and make, and we need to make sure that we're acting in the best interest of our shareholders with those decisions. And look forward to completing those deliberations with the board and coming to a decision and having it announced.
I would love to see the SWOT analysis on that and be a fly in the room as that conversation's going on. But I mean, to your point, from just even taking Germany, being you said $2 billion market. I mean, that's just one state here in the US, so the opportunity set is significant, and to have the ability to deploy cash, you can, cash in US cannabis goes a long, long way, and you have currency. So you have like both levers to pull. Then when you're looking at some of the, not to put the cart before the horse, assuming that would all happen, I think it'd be very interesting for that to happen, but just because we live and breathe in U.S. cannabis most of the time. But do you see an approach where you might continue to do more of like the debt positioning with some of these private companies, like you have been successful in doing, to consolidate? Or if that were to change, would you actually be looking at just trying to do more efficient, just outright, whether it's asset acquisitions, or how would you think about more activity in the U.S.?
It's a great question. So I would say that in terms of our credit capital deployment, we're beyond that phase right now. We had a specific program to deploy capital. We exhausted that program. We were doing this in an attempt to deploy capital with a strong sort of risk-adjusted return focus. And also, we knew that some of these companies were going to likely trip over time, creating additional opportunities. So what's unique about us versus some of the other capital allocators in the space is that we are not just passive investors, we're operators. So we have some really specific views on state of play inside the companies as well, in terms of what what levels of automation are appropriate and required to be successful, how retail should be positioned, how to deal with counterparties in the marketplace. And so we will likely focus on operations from this point forward, and are looking at other means of creating value. So when we think about investing in both organic and inorganic growth for existing exposures, we're also looking at our share price today and asking this question of, how cheap relative to intrinsic value is our equity today. And we've made a call to, which is really another form of M&A as well, if you think about it. But we've been acquiring our own shares in the marketplace over the last several quarters.
Right. Yeah, I was a big fan of Berkshire. Just coming back from Omaha, the mantra, you get more than you give when you're talking about equity, so that it's accretive. And I just love how simplistic that is of a kind of a saying, but how oftentimes companies do that wrong, right? Where they overpay, or there's, the stock is not in a good position to be doing that, where it's more costly. So, having that experience and understanding, I think is a very valuable aspect in being able to affect some of these outcomes. And I'm assuming even if you did go forward with, transition to the OTC, you would still maintain, that it seems like it's your ethos of a governance mindset of keeping that board dynamic. So you would still have all the infrastructure and plumbing to re-IPO, right? Or are there costs that you would potentially look at trimming back, but in the interim until that day comes, because we honestly have no idea when higher exchanges will happen.
The answer is absolutely. So, if you look at our status today, we are a SOX compliant SEC registrant. And so the cultural requirements to deliver on those fronts and maintain compliance, those are muscles that we don't want to let atrophy, and are really critical for the performance culture that we're trying to build. So there are some areas where we can reduce expenses, and that'll be really attractive if we were to go down that road, if our board makes the decision. But in terms of having the capability, discipline, and operating within a very strict controls environment, that is not likely to change. We've had a great partnership with the NASDAQ, which continues to this day. They understand really clearly the quagmire that U.S. cannabis operators are in, and are very clear about the fact that a lot of the initial safe banking drafting, while would provide for major U.S. banks to work with the sector, wouldn't necessarily create a clear path even to uplistings, right? So this stuff will change over time, but maintaining discipline is critical to our success, and it goes down to again, having teams that understand business drivers, that can react quickly, that are measuring performance on a frequent and ongoing basis. And so I would just say, even if you look at our quarterly releases and our disclosure, you're not going to see a rash of adjustments in our financials. And we are focused on what we think matters, which is effectively, and most importantly, revenue, unadjusted gross margin, operating income, and free cash flow. I think we can agree that EBITDA, especially in this industry, has been tortured to death, and some operators, and there's some real poster children for this that I won't call out, but we need to get beyond a point where if we don't like a number and we don't want to present it, we just adjust it out of the mix. Like, that is not appropriate, and that type of behavior is never going to inspire confidence from institutions. And so trying to good, bad, ugly, present our results in the most transparent manner possible, telling and making sure investors know exactly how much cash was generated or consumed in any given period, we think is going to build trust. And I think that these difficult times in the industry and in the global markets generally, I view it as the best possible time to build trust with counterparties.
Yeah. I mean, just continuing on my Berkshireisms, EBITDA is bullshit earnings. And my wife and I were just talking about this last night, because she works at a large public company, and they had their queue out, and she was like, what is EBITDA? And I was like, and I just said bullshit earnings, because it's just, and I think it's even more applicable in our industry, sadly, because of the landscape that we live in. Because there's just, there's too much liberty in it. It's just, so it's like, and I know it's a common metric that's just accepted. But I appreciate the,
in a context where it closely mirrors operating cash flow, and capital allocators and merger partners can otherwise adjust for capital structures, then I think you have a strong argument that there's some usefulness or basis for it.
Sure.
To cut across, large swaths of peer analysis, things like that. But I couldn't agree with you more. When you look at the cost of capital in this space, so we've got businesses out here with the cost of senior debt in the teens, right? But let's not talk about that, and and let's not talk about tax rates. Like, it's complete nonsense.
Right. Yeah. I mean, the numbers are starting to come out, and I have my tracker, and I plug in adjusted EBITDA and operating cash flow, and you can see those. Some of them are just, you could drive a truck through them. GTI is typically the tightest of the cohort, and so just exactly to your point. So, Jesse, I don't want to if you had any U.S. questions before.
Yeah, I think we can transition into the next section with a bit of U.S. context. I'm curious, Zach, can you talk a little bit about, in the U.S. landscape, thinking about deploying capital here, broadly, to the extent you feel comfortable, what types of businesses interest you? Sometimes Morgan and I talk about the benefits of being vertical. Obviously, that's super helpful. You see that in the Florida margins. Sometimes we talk about the challenges with cultivation, and maybe people like these days to lean into lower cost, large scale. Others like to build a strong retail footprint. And if you collect, some high quality doors that you don't think are going to get diluted, in the short term, some people like that retail approach. There's different ways to think about investing in the U.S. market. Are there any particular traits you are looking for when you're allocating capital here?
It's a great question. I think the preface needs to be, we're not working off a whiteboard here. So it's not you and me saying, new fund, what's your favorite opportunity? We have asset exposure today, and that's a lens that really gives us a perspective on priorities, right? So I would say that we're keenly focused on the Florida market. There's a handful of operators that are very keen to drive consolidation in that market. Some have some very specific skill sets, and there's a few very talented managers that we do interface with. In those cases, we're really looking for operating leverage. So it can't just be 1+1. There needs to be a capacity benefit, a skill set benefit, a processing benefit, some type of synergy at retail, but really need to see that observable opportunity for operating leverage. We've got exposure to Michigan, through Skymint. Michigan looks as close to the Canadian landscape as I've seen any market look in the United States. And so, what have we learned? That the discount retail model, where gross margins are pushed from certain operators that are running in the 30s down to the upper 20s, and the resonance that drives and the foot traffic that drives with consumers. I think there's a real opportunity in Michigan. We see some very large floor plates. We see some retail environments that have several hundred just edible SKUs, right? Like the breadth of the SKU set and the working capital required to build that theater for consumers is interesting. And then I would say one of the areas that's really interesting on the regulatory front, like we own a license in Texas, so watching this process around hemp, in working through the legislative process in Texas is really interesting. Sounds like one way or another there'll be an outcome this summer. We don't really have an opportunity to invest in scale in that market because it's so insignificant today. It's small, but Texas should be a very important market in the future, and that could potentially change, in the near term.
And my last capital allocation question for you is, you have a big balance of, what is it, $783 million in unrestricted cash and no debt. So that gives you a lot of flexibility. And one thing you've been doing, Zach, is a stock buyback program. We've seen that a little bit here in the U.S. with GTI, maybe TerraSen, maybe a couple others, but not too much activity in the buyback front here. But it does give you a ton of flexibility to do things like buy back your own stock. So how do you think about that as a capital allocation decision to buy back your stock, and how do you think about that moving forward in this environment?
It's a great question. Just to clarify, the $700 million balance that you referenced, that's our cash and investment book. So our unrestricted cash balance, if we're talking about investments and allocation, we closed the quarter about 220 million of cash, and that's a Canadian dollar balance, and no debt. So our only material liabilities are the lease exposures that we have, and those are capitalized under IFRS methodologies. So the balance of that 700 is both equity and credit investments, which if consolidated, they'll change form yet again. But effectively, that's what I think has been a challenge for our investors to understand and appreciate. Where, for example, Q4, our business generated absolute positive operating income. But because we hold our exposure to Sunstream as a single line item, which is effectively an adjusted NAV, on the balance sheet, as we have written that balance down with fluctuating valuations in the U.S. space, we've taken a series of charges which reduce our net income, while our overall operating business continues to improve quarter after quarter, and we've continued to hit records in the last several quarters, and expect to do so in the future. So the resolution on that and the completion of these reorgs and stability in that valuation will put us in a very different position, quite quickly. So I would say we have gotten to a point where we already have line of sight on being, north of $1 billion on the top line. In fact, we should be close to, in the next 12 to 18 months, crossing $1 billion in US dollars on the top line. But we can never take steps and to sort of put blinders on with regards to our cost of capital and the valuation of our equity. And there could be scenarios where there aren't many investments that can generate the type of implied returns that we can earn with our own stock. It's always a careful balance. There's a bit more art than science, because having scale and very stable and growing cash flow in itself can create a cost of capital advantage. And on the flip side, even if your stock is cheap, engaging in an exercise where you're trying to shrink to greatness can also be really difficult. In this industry, scale, trading liquidity, all these things are going to matter. So taking an opportunity that reduces float, drives either intrinsic or book value per share to an accretive level is interesting, but there are also ways to challenge that when you think about building a world-class business that's going to have global scale.
And one last question, then I'll throw it over to you, Morgan, to close it out with Ask Grok. But I'm curious, Zach, we've used the word opportunity. Like if you searched for opportunity in the transcript, you'd see the word opportunity in today's conversation a lot, which is, not something that we always talk about when we're talking with MSOs or others in the space. So I think that's a credit to you. Your business does have a lot of opportunity. When you look out over the next 12 to 18 months, which of these opportunities or even outside of these opportunities, what are you most excited about?
So I would say that the two biggest opportunities in front of us that will be meaningful catalysts that are appreciated by our investors and will benefit all of our stakeholders. And again, we have some great things going on in Canada, and the team is absolutely firing on all cylinders. But getting resolution on these long-tailed restructurings that have been going on in the US for too long, frankly, and that's all a function of not being able to avail themselves of the federal bankruptcy regime, which has been extremely painful. That resolution is both an opportunity and a material catalyst for the business. But I would also say, if you're talking about 12 to 18 months, we need to hit that important milestone of the start of what will be consistent positive net income. And again, part of that is to have these U.S. asset values stabilize. But that's absolutely part of our path, part of our future. And I think that would be the most meaningful step that investors could see over the next 12 to 18 months.
Want to take us home with an Ask Grok, Morgan?
Sure. So, a lot on our minds here have been, just watching what's for months now, maybe longer. I mean, years actually, if you think back to the Constellation Canopy deal. Don't need to talk about that, but alcohol and cannabis, right? And so my question this week to Grok, the alcohol and cannabis industry were on a separate journey for many years, but now the consumer is pulling these two together. And I asked Grok, what's your take and what could that mean for progress? And so Grok gave me a few different bullets, and I tried to skinny it up. So consumer-driven synergy, the convergence of alcohol and cannabis industries driven by consumer behavior is reshaping both markets. Perhaps are increasingly cross-consuming alcohol and cannabis interchangeably or together, seeking tailored experiences like relaxation, socialization, and creativity. The trend is fueled by shifting cultural attitudes, legalization of cannabis, and a growing demand for novel, personalized products. From a market opportunities perspective, the overlap is creating a hybrid market. Cannabis beverages, edibles, vapes are competing with alcohol in social settings, while alcohol brands are exploring CBD and THC infusions to stay relevant. Data suggests, I'm not going to read that because it was not accurate. But basically, cannabis is growing while alcohol has been facing some pressures from younger health-conscious consumers leaning towards cannabis. From an economic growth perspective, a merged market could create jobs from cultivation to retail and boost tax revenues in regions where cannabis is legal. But the catch, the industry's merger isn't seamless. Alcohol's entrenched infrastructure, distribution, retail gives it an edge, but cannabis regulatory complexity and stigma slow integration. However, consumer demand will keep pushing, and progress is dependent on harmonizing law and prioritizing safety. So I think that's interesting. I know, it's been a common theme for, more of Canada's been reaching, kind of already bringing these two together. So just, but it still is, very early days here in the US, how that's going to all come together.
Absolutely.
Are you a cannabis beverage guy at all, Zach?
I've been trialing a number of beverages. There's hundreds of brands in the market these days. I don't think I'm the target consumer. We're going to be manufacturing and selling millions of cans in Canada, actually. So we have manufacturing expertise in every relevant product segment at this point. And so some very interesting offerings, and I'm always interested to see what's resonating, which SKUs effectively or formulations are resonating with consumers, and continue to try new innovations in the US. I think that the sort of debate between the hemp and cannabis participants and players is quite fascinating. And again, frame of reference in Canada, we don't have a farm bill to have a loophole to deal with this. So we're going to have to push in different ways to have THC infused beverages show up in alcohol retail. But I fully believe that it'll happen at some point in the future. It's just a matter of how long that really takes. And I think that the opportunity.
I lost Zach. Did you lose him on your side, Morgan?
I did, yeah. I thought it was just my glitchy Wi-Fi today, but yeah, it looks like we lost him. Hopefully lost him.
Okay. Well, no worries. We're just getting to the end of the show then. But yeah, Zach was a great guest. Seemed like clearly a super smart guy with a really, really strong background. Enjoyed having him on the show.
Yeah, me too. That was really interesting. And they certainly have quite a compelling footprint that they can, as you said, a lot of opportunity.
Zach, we were just glazing you, as my kids would say. Glazing is the term that kids use for saying effusively nice praise about someone. So we're just saying that you were a great guest and seemed like a really smart guy, and we enjoyed having you on the show.
No, really appreciate it, guys. Thanks so much for having me, and look forward to continued conversation.
Well, sounds great, Morgan. Always good to chat with you. Thank you all for listening. Thank you all for watching on YouTube, and we'll talk to you again soon.
Thanks,
the views
guys.
expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research or recommendation. All investing involves risk, including the loss of principal.